A very good morning to all of you who joined the webinar. We are already overwhelmed by the number of people in the waiting room. So without any further ado, let us begin. I'm Shubhang Bhattacharya, the Group Marketing Head of ANA Associate, and I'll be kicking off our webinar session for today. Before we start our webinar, just a few ground rules for everyone. I would like to request everyone to keep themselves on mute for the entire session. Towards the end of the session, we will be having a Q&A round for all of you that have questions. So how do the question and answer session work in this segment? Please use the chat option of this Zoom meeting to put in your questions during the session. Towards the end, I will be personally putting forward your questions to the experts on the panel. So once again, kindly be on mute through the session, and towards the end of the session, on the chat option, please leave in all your questions that you have, and I'll be putting them forward to the experts one by one. So once again, welcome to our webinar. We will be doing our first corporate tax filing webinar for this year. We are very excited to have all of you here today. We have a concise session on everything that you need to know for your first corporate tax filing. Today we have with us an expert panel, but let me start with the big guns first. We have with us the General Manager of the Accounting Division of ANA Associate, Mr. Sandeep Anand. Sandeep Anand is a seasoned accounting and tax professional with over a decade of experience in the UAE. Since arriving in Dubai in 2010, he has witnessed the region's evolving accounting, tax, and compliance landscape. The background in leading roles at major accounting and audit firms, Sandeep has helped businesses navigate complex regulations. His experience with diverse clients shapes his strategic approach to financial advisory. Currently, he heads a team of 40 plus professionals, including chartered accountants and tax experts, driving excellence in financial management and compliance. So without further ado, let's kick off the session. I hand over to Sandeep Anand to take it from here. Over to you, Sandeep.
Hi, thank you, Shubhang, for that wonderful introduction. Good morning, everybody, and I welcome you once again for this corporate tax webinar with a special emphasis on corporate tax filing. I think there would be a lot of new insights, especially if you're a new business and who want to understand how to deal with the compliance relating to corporate tax. I think this would be a great start for you. At the end of the webinar, so you would also have a question and answer session like what Mr. Shubhang had actually mentioned earlier. So that is where you can pose all your questions. To take you through the subject, Hema, my colleague, who's had a lot of experience working in the accounting and taxation industry, she's been particularly carefully watching the corporate tax implementation and had her notebook and pencil out as soon as she heard that the corporate tax was being introduced. So she is to date with corporate tax requirements, and she will be a very helpful guide for for you. So without any further ado, I hand it off to Hema. Hema, take it over. Hema, unmute.
Thanks, Sandeep and Shubhang, for the introduction. Good morning, everyone. I'm Hema Mitra, Qualified Chartered Accountant. So today I'm going to take you through the session where we are going to understand the overview of UAE corporate tax and some of the basic rules and regulations that you should be aware getting ready for your first corporate tax filing. So let's get started into the session. So you are having a look at the 5 major topics now, which we are going to cover in today's session, which will give you a basic understanding of how are we going to get ready for your first corporate tax filing. Now, let's understand, why is corporate tax introduced in the UAE? So, in the past few years, you can see that UAE has been experiencing a lot of tax reforms in its tax system to streamline with international best practices. With the introduction of value added tax, followed by economic substance regulations, country by country reporting, and reporting of ultimate beneficial owner, you can see a number of changes that's been happening in the system to cope up itself with the international market. So now we have corporate tax introduced and applicable for all financial years starting 1 June 2023 onwards. So corporate tax is there for having a competitive tax regime in the country and also to avoid any harmful tax practices like tax evasion or profit shifting from a high tax rate jurisdiction country to a low tax rate jurisdiction country. And that's why we have corporate tax in the UAE now. Now, as business owners, you should be aware of some basic information like what are the tax rates, what is the tax period for which you're going to pay your taxes. Now, let's look at the tax rates. There are three tax rates: 0%, 9%, and 15% under the UAE corporate tax law. Now, if you are a business having taxable profits less than 375,000 AED, then you are to pay 0% taxes. If your taxable profits are greater than 375,000 AED, you are supposed to pay 9% taxes. Now, what is taxable profit? Let me explain that. So, as business owners, you all prepare your books of accounts to know the profitability of the business, to take key decisions, operational decisions, etc. So, these are your accounting profits. What are taxable profits? So, the UAE corporate tax law lists out a number of adjustments that has to be done to these accounting profits to arrive at the taxable profit. Now, what are these adjustments? I will be covering in the later part of the session, but just be aware that taxable profits are the basis on which we are going to base and calculate the taxes. Now, you can see that there is a third rate, which is 15%. Now, what's this 15%? Pillar 2 of OECD's Base Erosion and Profit Shifting Framework has introduced a global minimum tax rate of 15% for multinational companies who have a global consolidated turnover of over 3.15 billion AED. Now, this global minimum tax rate of 15% was introduced to ensure that multinational companies pay taxes in the country in which they earn their profits, and they don't shift profits from a high tax jurisdiction country to a low tax rate jurisdiction country. So these are the three basic tax rates that we have. Now, let's look at what is a tax period. So it's important to understand what's the period for which you're going to pay your taxes. So a taxable person can have its financial year for 12-month period. It can be a calendar period, which is from Jan to December, or it can be any 12-month period, which it can decide based on its operational needs. Sometimes the taxable person can also elect for a different tax period, which can range for a period of 6 to 12 months. 18 months. So when does this happen? Usually during the first year of operations. For example, if you have set up your company on September 2023 and your financial year is from Jan to December, the first financial year can be from September 2023 to Jan 2024, which will be covering a period of 16 months. So during the first year of incorporation, this change can happen and you can elect for a different taxable period. So these are some of the basic information. Now, who is supposed to register for corporate tax? Let's understand that. Here there are two categories: a natural person and juridical person. Natural person, individuals like you and me, and juridical persons are companies. So both natural person and juridical person can either be a resident or a non-resident. So let's look at natural person in detail. If you are a natural person resident in the UAE having turnover exceeding 1 million, then you must apply to register by 31st March of the following calendar year. For example, if you have 1 million turnover crossed during the year 2024 Jan to December, you are supposed to register by 31st March 2025. Now, what happens if you are a non-resident? The same turnover condition applies. If you are crossing your turnover of 1 million, you have to register by 3 months from the date of fulfilling such condition. So this is for a resident natural person and a non-resident natural person. Now, what happens if you are a company registered in the UAE, that is a juridical resident person? So here the criteria is if you are incorporated prior to 1 March 2024 or incorporated on or after 1 March 2024. So if you are a company registered prior to 1 March 2024, the deadline is based on the date of issue of trade license. So FTA had listed out a list of deadlines based on the trade license issue date. Now, I have not listed out that list here because the deadlines have already crossed as of 31st December 2024. So just be careful. If you are a company who is registered prior to 1 March 2024, you have already crossed the deadline and you'll be getting a penalty of AED 10,000. So action on it immediately and get your company registered. If you are a company who's incorporated on or after 1 March 2024, then you have to register within 3 months from the date of your incorporation. So this is for a company who's a resident in UAE. Now, what about a company who's a non-resident in UAE, which is foreign company? Now, you can see a new term here, which is called as a permanent establishment. Anyone who wants to attempt to answer what's a permanent establishment, you can quickly answer on the chat if you know the answer. Yeah. Okay, so let me explain what's a permanent establishment. A permanent establishment can be a factory or a branch office, or it can be a supervision site, it can be a building site which is in existence in the UAE for more than 6 months, and also where the key managerial decision makers of the foreign company are residing in the UAE. So these are the criteria which will fall under a permanent establishment. So if a permanent establishment of a foreign person is existent in the UAE prior to 1 March 2024, you must register within 9 months from the date of existence. If it is in existence after 1 March 2024, then you should be registering within 6 months. Now, let's look at what is nexus. Nexus in simple terms is immovable property. If you are a foreign company earning income from immovable property, then you are supposed to register for corporate tax. So this immovable property can be a commercial property which is used for business as well as for investment purposes. So if you are earning any income from immovable property, then be careful. You have to register for corporate tax. And the registration deadlines are if the nexus is in UAE before 1 March 2024, you should register within 31st of May 2024. And if it is on or after 1 March 2024, you should be applying within 3 months from the date of establishment. So now these are the registration deadlines for each categories which we have looked at. Be mindful of the registration deadlines and do the registration on time, because if you miss them, then you're going to attract a penalty of AED 10,000. Now we have looked at some of the basic information and who are supposed to register and what are the registration deadlines that has to be met. What happens post-registration? Now I have done my registration, I have got my TRN certificate. What's next would be the question in your mind. And we get a lot of questions from business owners as well. Once corporate tax registration is done, what are we going to do next? So the next would be the corporate tax return filing, where you have to submit your numbers to FTA and pay taxes accordingly. And there is a deadline for this as well. Now, the deadline is 9 months from the end of the financial year. Now, I've already explained what's a financial year. It can be a 12-month period, or it can be which is a calendar year, or it can be a different 12-month period as well. Now, usually, where can you find this financial year? It's stated on your memorandum of association when you incorporate the company. If the memorandum of association is silent, you can also choose the financial year as per your business needs. And this information is put forward to FTA on the Emira tax portal when you are doing the corporate tax registration. And based on these details, your first corporate tax return period would be mentioned on your corporate tax certificate. And 9 months from the end of financial year is your deadline to submit the corporate tax return. So I have given you a few examples here. If your financial year is from Jan to December, it falls by 30th of September. If your financial year is from Feb to Jan, then it falls by 31st of October, so on and so forth. So be careful with this deadline as well. And what happens if you're not complying with this deadline? Of course, there's going to be a penalty again. And this penalty is 500 for each month you default up to 12 months. And it's going to be 1,000 dirhams from the 13th month onwards. So be careful and ensure that the corporate tax return filing is done within the deadline. So now we have looked at the deadlines of corporate tax return filing as well. Let's focus more on companies now. So we have companies who are registered in mainland and in free zone. Sorry, before we go on to the next slide, we have a poll question here coming up just to explain more on the financial year part. So people can attempt to answer this question. Can I have more participants, please?
So everyone, you can see the poll option. You can click your you can click the option that you feel is the correct one via the poll option.
Okay. So I can see a dilemma between the first and the second option over here. So just to explain, the right answer is the first option, which is 4th October to 31st December 2024. And your CT deadline would be 9 months, which is 30 September. So just to be clear, this is the first year of incorporation where the company is set on 4th October and the financial year as per the memorandum is Jan to December. So you have to cover the initial months as well, which is from 4th October to 31st December 2023. So that few months period also has to be covered in your corporate tax. So it has to range from 4th October 23 to 31st December 2024. Okay, so that's the right answer because there's a confusion between the first and the second option where I can see the answers. So the right answer is the first one. Okay. So let's move on to the next part. So here we are now going to focus more on companies. Companies can be registered in mainland and in free zone, and we have offshore companies, but we're not going to touch upon offshore companies today. So we have mainland and free zone companies. So free zone companies can avail certain tax benefits if they meet certain conditions to be a qualifying free zone person. If you are a qualifying free zone person, then you have to pay 0% taxes. So, what are these conditions to comply for a qualifying free zone person? So, the first point is maintaining adequate substance in the free zone or designated zone. What is maintaining adequate substance in the free zone? So, the core income generating activity of the business should be happening in the free zone. So the main activity of the business should be happening here, and it shouldn't be happening anywhere else in the country, or it shouldn't be happening outside the UAE. There should be adequate employees who are required to run the business, and they should be incurring adequate number of expenditures in the free zone, and they should also be having assets which are required to run the business in the free zone. So these are certain conditions which they have to satisfy to have adequate substance in the free zone. So there can be cases where the companies would be set up in the free zone, but the main activity will be happening somewhere else. Then you will not be able to satisfy this condition of maintaining adequate substance in the free zone. Also, there are chances when you can outsource your business activity. What happens when you outsource? So here the condition is you can outsource your business activity to another free zone person, but you should be having adequate supervision on those outsourced activities. So this is the first condition for maintaining adequate substance in the free zone. Now let's look at the second option, second condition. So this is deriving qualifying income. Deriving qualifying income is a bit more vast to be explained, so I will be jumping to the next slide to understand more on deriving qualifying income. So here we have the 5 sources of deriving qualifying income, which would be eligible for 0% taxes. So the first one is transactions with another free zone person. So if you are a free zone person having transactions with another free zone person, and the other free zone person is the beneficial recipient of the goods or services which it is receiving, and it has no contractual or legal obligation to pass on these items to another person, then they will be eligible to derive qualifying income. But these goods or services which are provided should not be an excluded activity. Now, what is excluded activity? Excluded activity is the list which is mentioned on the ministerial decision again. So this list will include any transactions with natural person, like any other businesses like banking, finance, insurance, leasing, etc. So if you are a free zone person providing goods and services to another free zone person, so that free zone person should be able to should be used to enjoy the benefit of those services and goods, and it should not be listed out in the excluded activity. Now the second one is income that is earned from ownership and exploitation of intellectual property, qualifying intellectual property. So what is a qualifying intellectual property? It can be patents, it can be copyrighted software, or it can be any right which is equivalent to a patent but is registered. So if you are earning income from ownership or exploitation of these kinds of qualifying intellectual property, for example, like royalties, then you are qualified as deriving qualifying income. So there is a formula for arriving at the qualifying income from qualifying intellectual property, but I'm not getting into the technical details of arriving at the formulas and all that. So but one more point to highlight here is that if there are any marketing related intellectual property, then those are excluded from the list, for example like trademarks. So now let's move on to the third source of income, which is income which is earned from immovable property. So if you are a free zone person having a transaction in relation to a commercial property with another free zone person that is a beneficial recipient, then this type of income will also be a qualifying income. For example, if you are a free zone person who is renting out a commercial property to another free zone person, then this income can be deriving qualifying income. So what is a commercial property? This is quite explanatory. It can be business offices, retail spaces, restaurants, etc. And residential properties are excluded from this list. Now, what's the fourth source of income? This is transaction with non-free zone person, but in relation to qualifying activities. Qualifying activities is again a list which is listed on the ministerial decision. So I'll just move on to the next slide to show you what are these qualifying activities. So these are the list of qualifying activities which is listed out in the ministerial decision. I'm not getting into the details of each and every qualifying activity because this would be a separate topic of discussion, and we will be able to cover this in a separate webinar if you guys would be interested. Let us know your interest and feedback, and we will be scheduling another webinar especially for qualifying free zone and qualifying activities with examples in detail. But here there is one important point that I would be like to highlight. And let's get into a quick question and answer session. What is a designated free zone and what is a free zone? What's the difference between a free zone and a designated free zone? Anyone would like to answer? On the chat box, please. Yeah. So a designated free zone would be a fenced area, and not a free zone is not a fenced area. So that's the difference. So difference between why it's important here is that in corporate tax law, there is no difference between a free zone and a designated free zone. All rules and regulations are same, except if you are doing a distribution business. So if you are a business doing distribution of goods and services, goods or materials, just be careful. If you will be eligible for a qualifying free zone person only if you are registered in a designated free zone. Now, what is a designated free zone? The list of designated free zone is already available on the ministry, so you can go and check out the list, which is already out for value-added tax purposes. So this list is already on the ministry. So this is one of the important point to be highlighted here for distribution business. Now let's go back to the prior slide where we have the fifth source of income, which is any other income. Now, a free zone can have any other income apart from these four sources of income that I have just explained. So this any other source of income should meet the de minimis requirements to have deriving qualifying income. Now, what is de minimis requirements? Here we have a threshold limit, which is lower of 85 million or 5% of the total turnover. So this any other income that you're going to earn should be meeting this condition in order to qualify as being qualifying income. Yeah. So these are the 5 sources of income which a free zone person should be having to meet the condition of deriving qualifying income and to enjoy having 0% corporate tax. So let's just give a summary. The 5 sources of income would be transactions with free zone person, where the free zone person is the beneficial recipient and the activities is not listed in the excluded activity. Income from ownership and exploitation of qualifying intellectual property. Income earned from immovable property, that is a commercial property in a free zone, where the free zone person is a beneficial recipient. The fourth one would be transaction with non-free zone person, where in relation to qualifying activity, where I listed out the qualifying activities. And the fifth one would be any other income where the de minimis requirements are met. Now, we have just looked at the second condition, which is in detail. So the first condition is maintaining adequate substance, and second condition is arriving at qualifying income. Now, let's look at the third question, which is a third condition, which is not elected to be subject to 9% corporate tax in the UAE. Now, what does this election mean? So, as a free zone person, you can say that I don't want any benefit of being a qualifying free zone person, but I would like to elect myself as 9% corporate tax. So, why would companies do this? There can be a free zone person who has some tax grouping benefits with other branches outside outside the free zone. So there can be tax grouping benefits, or there can be benefits of carry forward of losses as well, like where they can set off their losses between companies. So these benefits would be more beneficial for them, apart from being qualified as a qualifying free zone person. So in these cases, free zone person can elect for 9% corporate tax. But if you want to be a qualifying free zone person, you should not be making such election. So this is the third important condition. Now, the next one. The fourth one is complying with transfer pricing requirements and maintaining relevant documentation. What is transfer pricing? Transfer pricing is simply following arm's length principle. Now, what is arm's length principle? Let me give an example to explain that. So there is a person, owner A, who has two companies, one company incorporated in the UAE and one company incorporated, for example, in the US. So there are transactions between these two companies and there is a common owner. So these two companies are called as related parties. So any transactions between the UAE company and the US company is called as a related party transaction. And if, for example, there is a sale from UAE company to the US company, it has to be the price at which this sale is measured should be at market terms. Just because both companies have the same owner, they can't be charging any amount of price between these companies to lower or to higher the taxes in these countries. So what happens is they have to measure this selling price at market terms. So measuring this price, the transaction at market terms is called as arm's length principle. And this is a basic understanding of what is transfer pricing and how do you measure these market terms. We have a certain documentations and certain database which is available in order to comply with these arm's length principle. So you might need professional help in maintaining transfer pricing provisions. But what are the conditions or where are you required to have these transfer pricing documentation? I will be explaining in the future slides as well. But this is the basic understanding of what is transfer pricing. So any transactions between related parties should be at market terms, which is arm's length principle. And if you're a company having transactions with your related parties, which a related party can also be a individual, like an owner, the owner's wife, owner's dependents. So these any transaction between a company and the owner should also be at market terms. This, in most cases, would be salary. So if an owner is withdrawing salary, it should be on market terms based on his experience, based on his expertise, etc. So this is the fourth important condition. Now, let's go to the fifth one, which is maintaining audited financial statements regardless of the amount of revenue. So if you want to qualify, as a qualifying free zone person, you have to compulsory maintain audited financial statements regardless of your turnover. The sixth important point is the de minimis requirement, which I have already explained in the previous slide, where the free zone person's non-qualifying revenue should not exceed lower of 85 million or 5% of the total turnover. So if this de minimis condition is met, then that other income would also be clubbed under qualifying income, and you would be eligible to be a qualifying free zone person. So these are the 6 important conditions that have to be met for a free zone person to be a qualifying free zone person. So now we have a question here, a poll question here. Can we have the poll question here?
Yeah, we'll
Hema, the
set.
poll, they have answered all the three questions already.
Okay. Fine. Okay.
I have relaunched it again.
Right. So I'll just quickly explain the second question. So I've just mentioned retail store is registered and situated in the free zone. They sell goods to individual customers. Can this business be eligible for qualifying free zone person? So here, uh, I'm just looking at the answers. The answer is no. They can't be eligible for a qualifying free zone person because if you remember, a transaction from between transactions listed in the excluded activity list, which is transaction with two individual customers, are in the excluded activity list, and you will not be eligible as a qualifying free zone person. Okay, so this can apply for any retail business like restaurants, shops, etc. Okay. So now let's move on. Yeah. So we have looked into details of a qualifying free zone person. What are the conditions that have to be met to be a qualifying free zone person? Now let's quickly look into a comparison of mainland company and a free zone company based on these certain criteria. Now, tax rates. I have already explained. So, mainland companies are subject to 9% tax rate on taxable profits over and above 375,000. And qualifying free zone person, it's 0% on qualifying income, subject to the conditions that I have explained, and 9% on the non qualifying income. Now, small business relief. So I'll be explaining in detail what is small business relief in the next slide, but just to highlight here, mainland companies would be eligible for small business relief if your turnover is less than 3 million. And qualifying free zone persons are not eligible for a small business relief because obviously they are having the benefit of 0% already. Now, audited financial statements. Mainland companies have to compulsory get their financial statements audited only if your revenue is above 50 million. So, if your revenue is below 50 million, then you may not worry, it's not compulsory. But if you are a qualifying free zone person, then it's compulsory regardless of your turnover limit. Now, transfer pricing requirements. I've already explained to you what is transfer pricing, arm's length principle, having related party transactions at market terms. So this is a basic understanding. But if you are a company who is a part of a multinational group having a consolidated global turnover of 83.15 billion, then you are supposed to maintain a master file and a local file for transfer pricing requirements. And also, if you are a taxable person having revenue in a relevant tax period, which is more than 200 million, still you have to maintain a master file and a local file. Now, what are these master files and local files? These are transfer pricing documentations which are important to be maintained based on a database which is region-wise, or it can be country-wise or industry-wise, to arrive at the market terms of any transaction that is happening. Now, here you might need a finance professional's help to have a master file and a local file in place. If you have any further clarifications or doubts on what is transfer pricing and how these files are to be maintained, you can reach out to us on the email ID which is going to be put on the chat box. Today, I'm just giving a brief or an overview about what is transfer pricing. Now, next is accounting standards. So both mainland companies and qualifying free zone companies have to follow international financial reporting standards. Now, what is international financial reporting standards? In short, IFRS. These are set of guidance or principles which are set out by the International Accounting Standards Board that the accountants have to follow to prepare the financial statements. So these have to be compulsory followed by both mainland and free zone companies. Maintaining records. So both mainland companies and free zone companies have to maintain records, that is, prepare financial statements, profit and loss statement, balance sheet, and have all supporting documentations in place for a period of 7 years. So this is a brief overview or a brief comparison between mainland and qualifying free zone companies. Let's get into detail of what is a small business relief. So if you are a business owner out there who has a small and medium scale business, you'd be much interested in knowing what is a small business relief. And so let's see who can elect for a small business relief. If you are a resident person who's a natural person or a juridical person, you can opt for a small business relief. Now, who cannot opt for a small business relief? A qualifying free zone person, as I mentioned earlier, cannot opt for a small business relief because you will already be getting the benefit of 0%. A member of a multinational group with global consolidated turnover of more than 83.15 billion. This is because you will be falling under the global minimum tax rate, so you can't elect for any relief. A person who artificially separates their business to lower the revenue less than 83 million. So here, if you are a business owner and you are fictitious, you are want to separate the businesses to wantedly lower the revenue below 3 million. So you set up two companies, one in maybe a free zone and another one in mainland, or you are artificially separating your business to have revenue less than 3 million, then still you can't opt for the small business relief. So genuinely your business revenue should be lower than 83 million. Now, what are the conditions? The election for small business relief should be made for each tax period. And as I already mentioned, the revenue should be less than or equal to 83 million in the current and all previous tax periods. And this small business relief is available only for tax periods starting 1 June 2023 and ending on or before 31st of December 2026. So it's available only until 31st December 2026. Now, what is this small business relief all about? It's simply that you need not pay any taxes to the government. Because you are a small business with revenue less than 3 million, so you need not pay any taxes to the government. You have to elect for small business relief when you are doing your corporate tax filing on Imara Tax portal. And any other exemptions or reliefs or carry forward of losses, etc., won't be available to you because the government is already giving you a benefit. And also here, they're giving the flexibility of you need not maintain any transfer pricing documentation. But if you have any related party transactions, you have to be maintaining the arm's length principle. So this is in short what small business relief is, and this could benefit a lot of small and medium scale businesses. So just be mindful, and if you are eligible, make use of this relief. Now, let's get into the corporate tax return filing readiness. So, what are we going to base the corporate tax return on? Of course, it's going to be our books of accounts, right? So our books of accounts is going to be prepared based on international financial reporting standards, as I had already explained. So here, the UAE corporate tax law gives certain flexibility for preparing our books of accounts. If your revenue is less than 83 million, then they are saying you can use cash basis of accounting. If your revenue is greater than 50 million, then you have to compulsory follow international financial reporting standards. If your revenue is less than 50 million, then you can opt for IFRS for SMEs, which is IFRS for small and medium scale entities. Now, what is the difference between IFRS and IFRS for SMEs? IFRS for SMEs usually has a number of reduced disclosure requirements as compared to IFRS. So this gives a bit of, it makes work more easier for preparing of financial statements. So they are giving the leisure of following IFRS for SMEs with revenue less than 50 million. So we follow IFRS and we prepare our books of accounts and our accounting profits are ready. What is our next step? The next step is that we have to report these numbers to FTA on the Imara Tax portal. So what are we going to do with the accounting profits? If you remember, I explained in the first slide, there is a difference between accounting profit and taxable profit. So what are those adjustments I'm going to cover now? Let's look into these steps. Maintaining proper accounting records. So you have to maintain proper accounting records as per IFRS or IFRS for SMEs or cash basis of accounting based on your revenue, and you have your accounting profits ready. The next one is you have to identify your taxable revenue. Now, as a business, you can have your business operation income from business operations, and you can have any other income from investments as well. When you say investments, for example, you can have dividends from other companies. So, are dividends taxable? Can be a question in your mind. So, if you can recollect, dividends are paid in a company after paying taxes to the government. So, you are receiving those dividends which are already taxed. So, these dividends are exempt income. You should not be taxing them again. So, dividends have to be reduced from your accounting profits. So this is adjustment number 1 that we are talking about. So identify your taxable revenue, identify the exempt revenue, and reduce the exempt revenue from your accounting profits. Now, the next one is you have to analyze your deductible and non-deductible expenses of your business. When you say expenses of your business, the thumb rule here is that expense should be incurred wholly and exclusively for your business. It shouldn't be for the personal purpose of your business owner, or it shouldn't be for any other subsidiary or a branch. It should be wholly and exclusively for the business for which you are preparing your books of accounts. And there are certain other deduction rules which are mentioned in the corporate tax law. So I'll be highlighting a few examples to you. The first one is, let's look at entertainment expenditure. Entertainment expenditure, you all know what would be like, for example, restaurant expenses, recreational expenses, any events, etc. So entertainment expenditure can be incurred for both employees and for clients or business partners, shareholders, etc. So if entertainment expenditure is incurred for employees, then it is 100% deductible. So you can claim all expenses which you are spending for your employees. If the same kind of expenses you're spending for your clients or business partners or shareholders, etc., then it is only 50% deductible. So just be careful when it comes to entertainment expenditure and deduct appropriately. Now, what about fines and penalties? Fines and penalties, as the name itself explains, is not a deductible expenditure if you are paying it because you are defaulted in the law and regulations of the country. So fines and penalties are non-deductible, but there is an exception over here to be noted. If you have a contract with your customer and you have breached your contract, and say you have to pay some damages because you have breached a contract with your customer, those kind of penalties or damages that you are paying will be a deductible expenses in the due course of your operations. So just be careful, these are deductible expenses which is paid for breach of contract. Now, what about bribes? Bribes, straight away, non-deductible. So you have to add back bribes to your accounting profits and pay tax on it. Then one more example is, what about bad debts? So bad debts is if you are not able to collect certain amount of money from your customers. Say the customer is defaulting to pay, then you can write off those amounts as bad debts in your books of accounts. So those can also be deductible expenses, but it has to be calculated as per IFRS. And any provisions that you are making in your books of accounts for expenses, etc., all those are also deductible expenses, but provided all these judgments and assumptions should be done as per IFRS. And what about donations and gifts? So donations and gifts are deductible expenses only if it is paid to a qualified public benefit entity. So the list of qualifying public benefit entity is listed in the ministry. So only if you are giving donations or charity to these entities, it's deductible, and to any other persons, it's not deductible. And one last example which I can highlight is capital expenditure. So there is a difference between revenue expenditure and capital expenditure. So revenue expenditure is expenditure which is happening in the due operational course of your business. For example, repairs and maintenance, printing stationery, etc. And capital expenditure are the assets that you are purchasing. So the capital expenditure would not be deductible, but the depreciation on such capital expenditure would be deductible, provided the depreciation is calculated as per IFRS. So these are some of the technical terms. So on the whole, your books of accounts is compulsory to be prepared as per IFRS. So ensure that all these are in compliant and these deductions or non-deductions are adjusted for in your accounting profits to arrive at the taxable profits. Now, these are only few examples which I have highlighted here. There are many more to the list. If you have any doubts or clarifications relating to any of the other adjustments, then you can reach out to us. But today I have just given you a basic example of the adjustments. Now, after these adjustments, we have arrived at the taxable profits, and based on the amount of taxable profits that you have, which is less than 375,000, 0%, over and above 375,000, compute 9% and pay taxes to the government. Now, what happens if there are losses? If you are profits, you're going to pay tax. If there is loss, what happens? The UAE corporate tax law says you can carry forward these losses to the subsequent financial year, but you can only utilize 75% of the losses in the next year. So after utilizing 75%, if you have still any unutilized tax losses, you can carry forward to it to the further subsequent years. So these are the adjustments for taxable tax losses. So this is a basic overview of how the corporate tax return works and what are the adjustments or what are the expenses that are deductible or non-deductible for computing your taxable profits. So you can the corporate tax return is already open for financial years Jan to December 2024 on the Imara tax portal. You can open them and analyze them, and I have already explained a lot of benefits that are available for a qualifying free zone person. So you can look at them, analyze your business model, and understand if you will be eligible to be a qualifying free zone person, or if you are a mainland person, if you are eligible for small business relief, and make use of these reliefs or the flexibility that the corporate tax law has given you, and get ready for your first corporate tax filing. So I have a whole question here again. Can we have the question so that I'll just explain the question? Yeah, so here I have mentioned company B incurs AED 10,000 for entertainment of employees and 8,000 for entertainment of clients. What is the entertainment expenditure that is allowed as deductible expense under the corporate tax law? Yeah, most of you have got it right. It's 14,000, where it's 100% deductible for entertainment of employees and 50% for clients. So 14,000 is the answer. Yeah. Yeah, so now this is the basic overview of getting ready for your first corporate tax filing. So if you have any further questions, or please shoot out to us, and we will be able to guide you for any clarifications or any other explanations that is required. Because today's session was giving you an insight or an overview, or to be aware of actually what are the rules and regulations available, and what are the reliefs available. So let us know if you have any further questions, and we can help you out with it. So now over to Shubhang for the Q&A session.
Perfect. Thank you so much, Hema, for taking us through the extensive list. So we have a lot of questions in in the chat option. I'll be putting them to you one by one. Two things before I start the question. Please understand that we will be able to entertain any questions which are broad in nature. Any questions which are very specific to your business, we will have to do like a consultation with you, understand more, and that's something that you can reach out to us for, and we'll be happy to answer those questions. So any questions, if you feel we've left out your questions or we haven't had the time to get to your questions, we will be putting two email IDs out there, and you can email us and get the answers or book a free consultation with us. So let's start with the latest questions, and I'll slowly go on to the questions asked at the beginning of the session. So Luis Gonzalez has a question for small business relief. Where to apply to know if it is eligible or not?
Okay, so what you have to do is if you are the turnover threshold is 83 million. So if your revenue is less than 83 million, then you can go for a small business relief. So when you are your corporate tax return is open on the Imara tax portal, you have to elect there that you are going to opt for small business relief, and the corporate tax return would change accordingly. The disclosure requirements will be changing. It will be asking you a number of other additional requirements as well, like your financial statements, your financial numbers, etc. So you can go given all those information there and opt for small business relief. So it should be done on the Imara tax portal on your first corporate tax return.
Perfect. Jijesh wants to know if there's a place where they can check the list of deductible and non-deductible expenses. Furthermore, one more question we have regarding is there a portal or website that we can file the corporate tax? Where exactly can we do that?
Okay, so the first question for deductible and non-deductible, there is a specific list which is given on the ministry. The guidance is over there, which is called as a computation of taxable income. So there are certain examples which the FTA has put forward, but on the whole, the thumb rule is that your financial statements have to be prepared as per the accounting standards. So, and the other adjustments are listed out in the corporate tax guide. So the second question is,
Where can we file the corporate tax?
yeah. So corporate tax, of course, if you would have done the corporate tax registration already on the Imara tax portal, so you will be having your login details to it. You can log in, and under the corporate tax session, you can see that your corporate tax return would be open. So you can go there and you can fill in all your details and submit your corporate tax return.
Okay, Chris Conway wanted to know all his income comes from overseas, which is non-UAE sources. Is this amount taxable if paid through his FZC, free zone company?
Any income that is earned from the UAE company is taxable under the UAE corporate tax law, be it you are receiving it from overseas or some other country, it doesn't matter. But if you are a company registered in the UAE and you are earning income from the business operating in the UAE, then you have to pay taxes on it.
Understood. Eliana asks if a FZE company does not fall under qualifying free zone company, should it follow mainland taxation guidelines?
Yes. If you are not a qualifying free zone person, if you're not eligible to be a qualifying free zone person, you should be following the normal rules as per a mainland company.
Amazing. Christos wants to know what about electronic devices? Are they deductible?
Okay. So here, again, the concepts of accounting standards work. If your electronic devices are big, like maybe you are purchased an electronic device for, say, for example, 5,000, 10,000 dirhams, which is of capital expenditure, which can be used for more than 3 years, then it's a capital expenditure. You can capitalize them, but and charge depreciation as a deductible expense. But if you have small electronic devices like pen drives or any other cable, etc., which is for 100 dirhams or 200 dirhams worth of it, then you can directly put them as a deductible expense. So this is a quite judgment that is coming up from the accounting standards.
Understood. Bibiana wants to know, I think this is more pertaining to their company, but I'll still put it forward. If I open my company in September 2024, am I still eligible to do the corporate tax?
company in 2024. Yeah, September 2024. You have to register within 3 months from September 2024. And your first financial year would be starting from September 2024. And the end you can decide based on your memorandum of association or based on your operational needs what's going to be the end of your taxable period, but it should not be exceeding 18 months.
Okay, Jijesh has another question. Is there any schedule for fixed asset depreciation like MACRS?
Again, fixed assets depreciation schedule has to be prepared as per IFRS. So here in the UAE, we don't have any definite definite rates that we are using for fixed assets. It's purely based on industry practices. So we don't have a definite answer for this. We have to prepare the depreciation schedule based on the accounting standards and industry practices. Yeah.
Okay. Um, there is one question by Chanda regarding the penalties if we don't file corporate tax by the deadline, but I believe you covered it in one slide. But overall, can you give us an overview about the penalties?
So if you are not registering on time, the corporate tax registration, then you will be getting a fine of 10,000. If you are not going to do a corporate tax return filing by end of 9 months, then you will be receiving a penalty of 500 for each month up to 12 months and 1,000 from the 13th month onwards.
Understood. Mike has a question. If a free zone company closes or deregisters its business before completing the first full financial year or calendar year, how will be the process of corporate tax deregistration, and how is the corporate tax filing deadline in this case?
Yeah. So once you go for a deregistration, you have to apply for a corporate tax deregistration. So once you do that, the application will go for a pre-approval. So once there is pre-approval, then the final corporate tax return for that period will open up, and you have to file your numbers up to the date when you're going to close your business. Once that corporate tax return is approved, only then your corporate tax TRN will get deregistered. So you have to file for the number of months, which is when you're going to close the company.
Okay, Dana asks, is small business relief only applied to years 2025 and 2026? Is there any indication of what happens after this date?
We are frankly not sure what will happen. It's up to FTA. If they want to extend, they might extend, but there are chances that they won't extend as well. So it's up to FTA's decision.
Okay. I'm getting a lot of questions which is specific again to your companies, which is regarding when you have registered and do you still, I'll just entertain one here. But please be mindful for us to give you any company specific advice. We'll have to kind of speak to you slightly more. But I'll just take one question as an example. If a company is registered in February 2025 with Jan to December as financial year, do they have to file for corporate tax for less than 12 months?
So the company is registered in Feb. Yeah, so the first
2025.
corporate tax of the period would be from Feb 2025 to December 2025. So this would be less than 12 months. Yes, as I explained earlier, you can elect for a period which is from 6 months to 18 months. So here it would be less than 6 months, less than 12 months because it's your first year of operations.
Okay, Mariana asks, what is the depreciation for the property in brackets capital expenditure if purchased during leasing, and how many years for loss compensation can be carried forward?
Okay, if it is under lease, then you have to apply IFRS 16, which is leases. Again, this is a technical question. So we need to analyze the situation or the entire scenario, and only then I can give a proper answer to this. Yeah.
Okay.
So just reach out to us on the email with your scenario, and we can explain you in detail.
Amazing. And while Hema's touching upon that, if you check the chat option, we have shared with you Hema's email ID, so you can get in touch with Hema directly, or you can contact our team of experts at tax@aaconsultancy.ae, Once again, Hema at aaconsultancy.ae or tax at aaconsultancy.ae. You can actually put in your questions there and we can have a one-to-one with you, understanding what is your particular business scenario, and we will be able to advise you better on that. So for anyone who has, I'm still seeing a few questions which unfortunately, in the interest of time, we will not be able to take right now. So if you have any questions, please just copy these email IDs. First is Hema, that's HEMA at aaconsultancy.ae. And second is tax at aaconsultancy.ae. These email IDs connect directly to the team, and you can have a proper session with them in terms of understanding whether your business is eligible, not eligible, what are the next steps, how much time do you have, fines, everything. So, Hema, in the interest of time, I unfortunately will have to stop here. Thank you so much, Hema, for your time today and for taking us through everything meticulously. You all of you can reach out to her in case you have any further questions or inquiries. I would like to thank Sandeep for facilitating this and working with our team. Sandeep, the general manager of our entire accounting division, is always abreast with everything to do in this corporate tax, VAT, everything. So we will be working very closely with his team to bring you more such webinars in the future that can benefit your business. So once again, Hema, I would like to thank you, Sandeep, as well. Sandeep, if you'd like to say just a few things before we conclude.
Yes, Shubhang, thank you very much. Hema, I think you did a wonderful job. I guess a lot of our participants have, gotten a good idea of corporate tax. I understand that it may not be 100% complete, but they can always reach out to us for any further consultations. And as Shubhang also mentioned, we will be doing this more frequently. Next time it would be a specific subject within corporate tax. So by the end of a few sessions, you will be updated fairly well with all the requirements of corporate tax. It's very important because there is a section of business owners who may not take this with that level of seriousness. But there's if you have attended any other corporate tax webinars, also you might find that there are certain details which are very critical, um, and therefore it is important to get educated on the subject. And we offer these